Now, why would the volume be higher than the demand growth for the main primary driver, that being EVs? So I grew up thinking lithium was just the name of a Nirvana song.
And lithium used to be just in your grandma's medicine cabinet. The last time I studied it, it was in Psych 101 class. When you think of lithium nowadays, it's not exactly the same thing. Hey everyone, welcome back to Chipstock Investor. Today we're going to be talking about one lithium company that could be poised for explosive growth in 2024. And that company is Arcadium Lithium. Lithium companies have been taking an absolute beating in the stock market and in their revenues over the last couple of quarters. But we're going to talk about why this company is still something that we're interested in and possibly going to be adding to our portfolio in the near term.
We, of course, add more detail on these discussions in our show notes. You can access those on our Ko-fi shop, or if a monthly membership is your speed, we have that too. Access to our Discord channel, which you can get here on YouTube via a YouTube membership, or again, over on the Ko-fi shop via a monthly membership there. Okay, so let's talk about the state of the lithium market, Kasey. So I grew up thinking lithium was just the name of a Nirvana song.
And lithium used to be just in your grandma's medicine cabinet. The last time I studied it, it was in Psych 101 class. When you think of lithium nowadays, it's not exactly the same thing. Lithium has changed and become the secret sauce in many manufacturing processes. And of course, the lithium we're talking about right now is the lithium of electronic devices that is also extended into the EV sector as well.
So this is not an industry flowchart, but maybe a helpful introduction. When we discussed Albemarle and Tesla and its lithium supply chain a couple of months ago, created this chart to help with some industry terminology. This is some common terminology you'll hear in the metals and mining sector, of course, in the fossil fuels industry. Whenever you hear a company talk about upstream supply chain or upstream operations, what they're talking about is the actual mining. And then as you move downstream, you get into the refiners and distributors of the product. And then finally, the most downstream are the companies that utilize the raw material in some sort of manufactured product. In this case, lithium ion batteries. The part of the supply chain that Arcadium takes up, it's the most upstream part of the lithium market, the mining operations, and midstream, the refining. And Arcadium is the product of a merger that was just recently completed in January 2024. Australian-based Allkem, which focuses on the mining portion, pumping out lithium in Argentina and Australia, specifically the Mount Cattlin project in West Australia, which we'll talk briefly about later on. And then a new Canadian project underway, as well as a small Japanese refinery paired with Livent, which is primarily a refiner of raw lithium. Again, another big Canadian project in the works. We'll talk about the complementarity of its project with Allkem's. And you can see from the map here, lots of refining operations around the world. Allkem and Livent now combine to make this upstream and midstream lithium producer of high-grade products ready to go for lithium-ion batteries, for all sorts of mobile electronic devices, and of course, the big growth driver, electric vehicles.
Raw material mining, while it is potentially lucrative, is also a roller coaster ride. Sales swing wildly with ups and downs of commodity prices thanks to the interchangeability of products and intense competition. That volatility can make even a promising mine a profit seesaw. Think back to 2022. The EV market was on fire and lithium prices skyrocketed. Companies like Albemarle, which is one of the biggest players in this space, scrambled to dig up and refine as much lithium as they could. But then, of course, reality hit. We all went back to our relatively normal lives. EV demand slowed, although it didn't decline, contrary to what many media outlets will have you think. But Suddenly, lithium producers were sitting on a ton of lithium supply. And that's ultimately the problem with lithium and raw materials in general. It's a boom bust cycle. One minute, everybody wants it and prices soar, and then the next, demand eases and prices plummet. So, what's the solution? Some say integration is key. Mine the lithium, refine it, and then sell it all under one roof.
Yeah, and that's the course that Arcadium has taken. However, industry leader Albemarle has demonstrated, especially the second half of 2023, that a fully integrated lithium production operation from mine to refine is not a cure-all against these wild swings in supply and demand. Albemarle itself is currently working through a bit of a lag between a large chunk of raw lithium inventory sitting on its books and then the final sale of that inventory as a final refined product to battery manufacturers. That said, though, what has emerged is a durable and diversified business. Although, as we were preparing to record this, Kasey, we did see shares were falling again as the company announced it would be selling about 1.7 billion in new stock to raise cash, pay down debt, fund new investments and such. However, the key takeaway here, as we kind of sort through the rubble from what's left from the lithium washout, we're looking for companies that at their core are still highly profitable. Albemarle, we've already covered. Arcadium looks like it is also one of those highly profitable plays.
So, the ultimate question is, can Arcadium skirt this boom bust cycle? Both Livent and Allkem, before it became Arcadium, traded at a premium, about 10 times their annual earnings before merging. Arcadium now trades for 13 times trailing 12 months earnings per share as of March 5th, 2024. And that is a real standout compared to typical mining stocks like Albemarle, which sits at less than 10 times trailing 12 months earnings per share. That higher price tag hints that investors are hoping for a stronger than average growth, especially with the merger promising new possibilities.
Yeah, that's right. The road ahead is going to be bumpy, but there have been some comments that indicate that we are now at the bottom for the lithium market. Albemarle's been talking about that. Now Arcadium's management is talking about that. And it looks like as we bottom out, these companies are, again, at their core, profitable enterprises. So let's take a look here at these two companies on a standalone basis, Allkem and Livent, because we are still waiting for the pro forma combined financials from 2023, still waiting for the annual report to come out. Hopefully within the next couple of months, it sounds like that will be ready. But let's start first with Livent. You can see that they actually held up fairly well here. You can see on a quarter over quarter basis from Q3 to Q4, revenue down about 14% and down about 17% on a year over year basis. And while profitability did definitely take a sizable hit, nearly 60% down quarter over quarter, again, Livent, the refiner, a valuable business here, still profitable. These midstream operators like Livent that refine product, this is an important step that is often overlooked. And we'll get to this here in just a moment, but at every step in a manufacturing process, work has to be done. And that work has value. It's worth something. And so refined lithium, of course, is going to have a higher value than the raw material coming directly out of the ground. Allkem really, especially taking it on the chin, down 22% quarter over quarter in its main operation in Argentina. Even worse at Mount Cattlin in Australia, which is winding down operations because that mine is near the end of its life. The Livent portion of the business, the refining part of the business, can now procure very affordable product coming out of the ground, refine it, and then realize a step up in value from that product sold. So that's the rationale here. Of course, not going to skirt the ups and downs of the industry, but at every step, as you move from the upstream mining to the midstream production of the lithium material, you get a step up in value and a high rate of profitability. At least that's the proposal here.
The ultimate takeaway from these slides here is that Arcadium, like Albemarle, remains profitable even during this total washout from the lithium industry. Supply now is being taken out, consolidation is underway, and a new growth cycle does appear to be forming. Arcadium is emphasizing that this chart is not an outlook for 2024. This slide is showing two possible outcomes based on lithium pricing, or LCE, which means lithium carbonate equivalent. Arcadium management has indicated that the lithium market does appear to be bottoming, but they still expect to sell about 40% more volume than they did in 2023.
Yeah, and that is a big volumetric increase year over year. The ultimate profitability is going to depend not just on the price of lithium, but on the spread between what they're able to mine product for and then ultimately what they can sell the refined product for to manufacturers. But 40% volumetric increase, and you can see the pretty wide variance in ultimate profitability for Arcadium on an adjusted basis. Adjusted EBITDA, or earnings before interest, payments, tax, and then non-cash depreciation and amortization expense. But you can see the EBITDA profit margin range of 34% to 53% based on these two lithium carbonate equivalent prices of $15 a kilo and $25 per kilo. As of some of these reports, and including some recent comments from CEO Paul Graves at the Bank of America Securities Conference at the very end of February, that LCE equivalent price was actually right around 15 a kilo. These are based not on the spot price, but on Arcadium's contracts that they have with customers. And again, you can see some of the comments and our notes on it that Paul Graves made at that conference in our show notes.
We'll give you the TLDR version of those comments right here, right now. Focus on Arcadium's and other lithium producers like Albemarle's ability to turn a profit in good times and bad, rather than on the lithium spot price itself. Arcadium is demonstrating a great ability to do just that this year, turn a healthy profit, and grow volume of products sold along the way. With that said, why don't we talk about the outlook for 2024 in the lithium market?
Yeah, the big growth driver for lithium demand is still electric vehicles, EVs. Again, as you mentioned at the outset, Kasey, that some media outlets sort of implying that demand has now headed in reverse and that consumers are no longer buying EVs. That's false. Some consumers are, in fact, not interested in EVs. Totally normal for a growth market to expect not everyone is going to take up adoption. But globally, EV sales were up about 33% last year, and they're continuing to increase. We're looking at perhaps a mid 20% or higher growth rate in 2024. At least that's some of the initial outlooks based on manufacturer production, lower cost EVs hitting the market. And so that helps support a company like Arcadium saying that they're looking at about 40% growth in volume of lithium sold. And now, why would the volume be higher than the demand growth for the main primary driver, that being EVs? Well, there was a lot of lithium destocking last year, especially in China, where much of the battery manufacturing takes place. A lot of supply got taken out along the way as prices of lithium tanked. So we already, again, talked about Albemarle and some of its issues with its big project in Western Australia, the Greenbushes project. We've seen companies like Mineral Resources in Australia not expanding as quickly as they were before. Core Lithium actually recently closed down and ceased operating. That's another Australian-based lithium miner. And then again, that Mount Cattlin project in Western Australia, Paul Graves said that one may actually be closed by the end of this year or sometime in 2025 as that mine nears the end of its life. So the outlook at this point is we've had the washout. We've had the complete boom bust cycle at this point. And now when we say we're in the midst of a bottoming in the market, what's happening is the leading producers that are still profitable, especially the ones that are still profitable, given that prices have come down so much, now need to figure out how to rebuild their future supply. And that costs money. You don't just start a new mine from nothing. It costs hundreds of millions of dollars. And so companies like Arcadium, like Albemarle, and some others have the resources to do that. And we're going to enter this new phase over the next, let's say, 3 to 5 years, where new supply gradually comes back online, sustainably profitable supply comes back online to meet the really constantly and constantly growing and insatiable demand for lithium expected over the course of the next decade.
CEO Paul Graves reiterated this. He said that he feels like they're a little oversupplied right now, but not massively oversupplied. And he does not think that oversupply would increase at any point from later this year onwards. So, very bullish comments from CEO Paul Graves, and the market took notice. That's one of the reasons that it went up 10% after this Bank of America conference.
Yeah, that's right. Positive signs of progress here after an epically bad 2023. Now, we do expect this stock to be incredibly volatile going forward, but as we said we would back in December, we have been nibbling on Arcadium stock after the merger was completed in early January. The reason why we think those EBITDA margins, adjusted earnings before interest, tax, depreciation, and amortization, stay above 40% this year. We think earnings per share on a full year basis will remain positive, although there's probably going to be some quarters in the red. Free cash flow is also going to dip into the red because Arcadium is going to have to spend money to replace that Mount Catlin project. They do have some project expansions underway in Argentina and Canada, where the existing Allkem assets and Livent assets have a lot of complementarity. They can eliminate some redundancy now by combining those and have a full mine to refine operation in those geographies. But again, it's going to cost some money. And so free cash flow is probably going to be negative this year. So that said, Kasey, really bad stock price action. Is the stock cheap?
No, it's still not cheap. In fact, the trailing 12-month earning per share valuations are just completely out the window. They are meaningless, especially in such a wild industry like the lithium market. You have to focus on the company's volume growth and the profit margins that they can generate off of them on a go-forward basis. But based on our early 2025 estimates, we think Arcadium trades for around 5 to 10 times our expected earnings per share estimates, which we have pegged right around 50 cents to 70 cents on a GAAP basis, with major upside to those estimates.
We like the risk to potential reward here at this juncture for Arcadium stock. And then also, importantly, we think this actually adds some really good diversification to our portfolio personally, because semiconductor stocks in particular have continued to skyrocket the first couple of months of 2024, some of them in probably unsustainable fashion. And so we feel that adding a bit more to Arcadium is a way to diversify the right way, get an alternative asset performance into the mix in our portfolio. Now, we're not trimming any of our positions at this point to do that, but we have added some fresh cash to Arcadium and think we'll continue to do so in the next couple of months as well. So I guess in conclusion here, business looks to be in pretty good shape with upstream and midstream operations now being combined. Balance sheet is decent, about 240 million in cash and short-term investments, about 300 million in debt. And importantly, it looks like the ability to self-fund their expansion projects with cash from operations. So it's a smallish to mid-cap business in what should be a growth market again over the course of the next 3 to 5 years. We're still waiting for the annual report on this, so stay tuned for more info. But Arcadium looks like a promising business to us. It's a complicated market. Do lots of due diligence here. We highly recommend you read management's commentary, as well as some of the other major industry players as well, commentary from their earnings calls and different investor conferences as well, to get a more firm grasp on what is actually going on right now, because it's some weird stuff.
Hopefully, we have made this complex industry a little easier to understand. Please make sure you have subscribed to the channel to find out more about semiconductor stocks, lithium stocks, and some things in between. Make sure you have notifications turned on. And of course, if you're interested, you can always check out our Discord channel by joining our monthly subscription here on YouTube or over on our Ko-fi page. And we will have our show notes posted for this, as well as our most recent published manual for the cybersecurity industry. So if you haven't seen that yet, make sure you check that video out right here and the manual over on our Ko-fi page.
And speaking of cybersecurity, that's where we're going to spend the rest of our time this week. We, of course, did the updates on Palo Alto Networks and Fortinet, but we still need to get to Zscaler. And then tonight, we have CrowdStrike reporting. And on Thursday, we have Broadcom, the semiconductor giant, and now cloud computing and cybersecurity company too. More on that coming your way.